So welcome to class 7, which is the class that would ordinarily have happened or will happen on the 7th of April. We are pressing along quite nicely with our video content, and I hope you're enjoying this medium of lectures. It's missing seeing everybody's faces, but hopefully we will all be back together again soon. So in this module, we're going to talk about other legislation that impacts the board and the director's duties. We have discussed quite extensively the Companies Act and King, and there are some components of this particular lecture which do touch on the Companies Act, but we're also going to have a look at other areas that boards must consider. Okay, let's have a look at the JSE. I understand that not everybody works in a listed environment, but the aspiration, I suppose, is that everybody will have that opportunity to work in that listed environment. And it's very important that even at an introductory phase, you understand that the listings requirements have different requirements for directors. They have additional duties that directors need to fulfill, and there's lots of disclosure requirements. So in this module, we're just going to talk very broadly about what those are at a high level, and later on throughout the rest of your course you will go into the JSE and its particular requirements in more and more detail. Okay, so what is the role of the JSE? The JSE is a stock market where companies can list their companies and raise share capital. Essentially, it's all about the money. So they put their shares open on the market to be sold to whomever would like to buy them. They are not able to persuade people to buy them. It's not like you can go on an advertising campaign. Your results that you put out into the market, that would necessarily be your advertising campaign. People would then invest in your company through brokerages. You can't sell your own shares directly. And the idea being that essentially the more shares that you sell, then the more money you would get and the more value that's attached to those shares. So the equity value of the company is increased. It becomes more enticing for more people to invest in a listed company and in those shares once that share price starts to go up. They can then sell them at a profit. The other big aspect of that of having these listed shares is that quite often these companies will declare a dividend, which means that surplus cash and profits can then be distributed equally to those shareholders. So just being an ordinary shareholder, investing in one of these listed entities can be quite profitable. Most investors into JSE listed companies are large entities such as the Sanlam and Liberty and the PIC. And what these companies do, they're institutional investors. They group together monies from pension funds, insurance companies, property entities, and they make quite large investments into listed entities with this anticipation of getting a good return on that investment for those beneficiaries of the pension funds, insurance companies, and so on. In a platform like this, it's very important to be able to protect those investors and to make sure that there are systems and processes in place whereby honest trading can happen without any risk of fraud or manipulation, and that it can happen in an anonymous way. So when you buy and when you sell the shares, you don't know who you're buying shares from or who you're selling the shares to. And it happens very quickly on an electronic portal which is called Straight, which stands for Shares Traded Totally Electronically. The main purpose of the JSE platform is to enable this buying and selling of the shares that have now been listed on there. And then they have very specific rules as to how those interactions, the sale, the shares, and the relationship between the company and the shareholders, how that plays out, and that's set out in the JSE listings requirements. Okay, so as I said, the JSE offers a platform for individuals and institutions all over the world to buy and sell shares that are listed on the JSE, and it becomes a regulator to ensure that all the companies that are listed on the JSE comply with the listings requirements. So we all have the same set of rules that we need to comply with. Only certain companies can list on the JSE. They need to be public companies. Bear in mind, of course, that not all public companies will be listed. So if you do find a public company, it doesn't necessarily mean that it's listed, but all listed companies will be public. They must have had a profit history of at least 15 million rand for the last 3 years, and they must have issued share capital of at least 50 million rand. So these are typically quite large companies. They've got a long-standing profit history. And there is a smaller exchange, which is called AltX. It stands for the Alternative Exchange, where smaller companies can list. And it's a separate exchange, and they have slightly different rules, but it still forms part of the JSE as a whole. Okay, let's have a look at the listings requirements. The purpose of these rules is to protect the investor, the shareholder. The listings requirements is fundamentally a set of rules that all companies listed on the JSE must comply with. And in these rules, they refer to listed companies as the issuers, being the issuers of the share capital. Every director who is on the board of a listed company will need to sign a declaration acknowledging that they are bound by these listings requirements. And non-compliance by the company as a whole or by directors specifically can result in some pretty hefty fines to those directors, to the company, and a public censure. A public censure is quite embarrassing because what the JSE does is they announce on SENS that they have censured you and that you've paid a fine. So it has reputational risk for the directors involved. The listings requirements are formulated by the Listings Advisory Committee. What they do is they continuously research markets and practices and learnings from trades that have happened, and they make recommendations based on that to update the rules. And they do this on a fairly regular basis, so you have to continuously make sure that you're up to date with the listings requirements. They go through quite a bit of stakeholder engagement, and their primary function is to make sure that these rules continue to ensure that investors are protected. The JSE Executive Committee then introduces the updates to the rules and makes them law for listed companies. The primary area around these rules that has an impact for company secretaries is particularly related to disclosure. The idea being that all shareholders must have access to the same information at the same time. So there's no shareholder who sits with certain information that other shareholders don't and then has a benefit from that information. He can trade or he can not trade and avoid a loss as a result of having that information. So the JSE provides this portal called the Stock Exchange News Service, which is a bridge to SENS, and companies can make their disclosures onto SENS, and as soon as a disclosure is made onto SENS, then it's deemed to have been made to all shareholders. Some of these listed companies are obviously very big, and you can't phone up all those shareholders or even email them at the same time. There's certain things you can send to them by post, but that's still going to be quite a time-consuming process. So if you've got something that you need to tell your shareholders immediately, you can put it on SENS, and you will have been deemed to have communicated with all your shareholders at the same time. And that's where the JSE would also publish its public censure notices. Let's have a look at price-sensitive information and insider trading. This is obviously a very interesting topic, and there's a lot of movies that you can watch that focus around this, and it's the one area of the JSE which is really quite sexy. So let's look at price-sensitive information. This is information which may affect the share price. It's usually information that is known to the directors or the senior managers and people who operate in the day-to-day area of the business. It's confidential by nature, and it's information that is not already widely known. So if there's information which is in the public domain, it wouldn't be considered necessarily price sensitive. If it's immaterial to the company, it wouldn't be price sensitive. This is information that can really move the share price and would typically revolve around the company is doing a merger or it's an acquisition, there's some other big corporate action, the company's going to enter into a big contract that's going to be very profitable and it's going to make a lot more profits as a result of that contract. So people may want to buy into that share price. Say, for example, it's trading at 10 Rand, but once this contract is signed, and there's that expectation of the better performance from the company and this increased earnings, that share price might go to 20 Rand. So you don't want to pay 20 Rand for that share price when you could actually get it for 10 Rand. So hence the almost desire to be in possession of price sensitive information and the value of it, given the need for all shareholders to have all information at the same time. It's really important to make sure that price sensitive information is dealt with very carefully in this environment. So there are quite a lot of rules and regulations around this. And if you trade while you are in possession of price sensitive information, so information that is not available to other shareholders, then that is insider trading and it's a crime, because the person has an advantage over other shareholders who don't have the same information. So they're not on an equal footing. Anyone who trades whilst in possession of inside information will be guilty of insider trading. Just because it is typically the directors and senior employees who might possess this information doesn't mean that it's restricted to them. So this is often where we find this golf course scenario where a director will be just buddying up with his friend on the golf course over drinks and say, oh, we've got this contract, a nudge and a wink, buy some shares now because the share price is going to go up. And then the friend goes along and he trades in the company shares, or he tells somebody else to trade in the company shares. At the moment at which that trade takes place, that person will be guilty of insider trading, even if they're not a director or an employee of the company. Insider trading has very serious sanctions and penalties and can go up to 50 million Rand, but can even go higher than that. So let's have a look at when directors trade in shares and when they may not trade in shares. Just a bit of background to this. Lots of executive directors do hold the company shares, and there is a good reason for why they should do that. Mostly being that other shareholders, external shareholders, would like the company's directors to be aligned with their own interests to some extent. So if the directors own shares, they have a vested interest in what shareholder interests are. These shares that the directors hold are typically a very small percentage in comparison to bigger shareholders. Most of these executive directors won't even hold 1% of a company's shares. It's more a philosophical holding that they might have. That aligns their interests with that of the shareholders to some extent. They also get these shares through incentive schemes, which you've probably read about, and you're quite aware that companies will issue shares to employees, including directors, as incentives to grow the share price. So that's also a very positive aspect of holding these shares. It then becomes quite tricky for the directors and the senior executives as to when they may actually trade in these shares that they own in the company. They absolutely cannot trade when they are in possession of price sensitive information, as we've discussed. They also cannot trade in certain periods, certain time periods in the year, and we call these closed periods. They take place between the financial year end and the time at which the company publishes its financial statements. So if the company's year end is the 28th of February, it has 3 months to publish its financial statements. So that will be the 31st of May. And in that period, it will be considered a closed period, and then the directors and the senior managers will not be able to trade in those shares. And exactly the same scenario at half year end to the publication of the interim results. So if you had a year end of 28 February, your half year end would be the end of August. So from the end of August to the end of November, that would be a closed period and they would not be able to trade. So that takes 6 months out of the year immediately for directors. They only have the other 6 months in which they could possibly trade, and then they simply cannot trade when they have price sensitive information. So if at any other point they're doing a deal which might impact the share price, or there's a contract, any of the examples I mentioned, then they would be prohibited from trading. So it does make it a little bit tricky for these people to do that. One of the other instances when a closed period is triggered for directors and they may not trade is when the company has issued a cautionary announcement. We will discuss what a cautionary announcement is, but when that announcement is made by the company, directors also cannot trade to the extent that that cautionary announcement is in the marketplace. So when they can trade, first of all, when they are not in possession of price-sensitive information, which can be quite difficult, and when the company is not in a closed period and not underneath a cautionary announcement hasn't been issued, and the chairman of the board must give approval for the directors to trade. So they have to go and get his permission, his or her permission beforehand. If the chairman wants to trade, then typically the chairman of the audit committee will give that approval, then or possibly the lead independent director. There needs to be a policy in place that manages these matters. If a director does trade in the shares, first of all, that trade must be announced on SENS, so other shareholders know that directors are dealing in the shares of the company, whether they're buying or selling or accepting a grant of share options, whatever the case is. If they are dealing in these shares, they must be announced on SENS within 24 hours of the trade. That can be quite tricky to do because you've got to get a broker notice, and then you've got to compile your SENS announcement. So it becomes quite a tricky time management tool, but it's got to be within 24 hours because that in itself is considered price sensitive to the other shareholders. So we need to tell other shareholders very quickly that directors have been dealing. And in this announcement, we must disclose the number of shares, the price at which these shares traded, and we must confirm that the chairman gave permission for this trade to take place. All of these things will be encapsulated in a policy by the company on how it trades in the company's shares, how the directors trade in the company's shares, and on inside information and how it manages inside information. So if you go and have a look at listed companies on their website, go and see if you can find in the governance section policies around directors' dealings and dealing in the company's shares. And on a lighter note, and to make sure that you never forget about insider trading being a crime, this is Martha Stewart. She was an American household name and a cook. She had a TV cooking show and a whole home enhancement show. She was very wealthy, and she had a company that ran this business, and she made a lot of money out of it. It was listed on the New York Stock Exchange, and she heard, in her capacity as a director of her company, she heard that something was going to happen that was going to impact the share price. So she quickly went and sold a whole lot of her shares because she wanted to avoid the loss that might have been made. And she was found guilty of insider trading, and she went off to jail. So even a very famous person, even a nice homely housewife, can be sent to jail for insider trading. Now, let's look at how King is brought into the JSE listings requirements. King 4, as you know, has 16 recommendations for listed companies and their boards, but the JSE has taken some of those listings requirements, sorry, I beg your pardon, the JSE has taken some of those recommendations from King and incorporated them into the listings requirements. What this means is that they are no longer simply recommendations for listed companies. These are now part of the rules, and they are not um, even voluntary anymore. They are mandatory now for listed companies, and they go like this. Listed companies must have an independent non-executive chairman or a lead independent director. So you cannot have an executive chairman, and if you have a non-executive chairman who is not independent, then you must have a lead independent director. There must be some element of independence at the top. The board must be constituted of a majority of non-executive directors, and there must be a compulsory separation for the role of the CEO and the chairman. You can no longer have a CEO who is also the chairman. It has to be separated. Luckily, they must have company secretaries, which gives us some job security. They must also implement the rotation of directors, which happens on each director stands for rotation every 3 years, and it gives and this is typically the non-executive directors who will stand for rotation, and it gives shareholders an opportunity to vote those directors out, or voice their objections to those directors being on the board. They must have, listed companies must have audit committee, social and ethics committee, and a remuneration committee. And then companies must implement this non-binding advisory vote that shareholders have an opportunity to vote on in respect of the remuneration report and the implementation plan. They must make certain disclosures as well around their King 4 compliance or application of King. So they have to make, in the past we used to make a narrative statement as to how we had applied the principles. So typically when it was a comply or explain environment, King 1 and King 2, companies would say, we have substantially complied with King, which was very unhelpful to the reader because you would have no ideas as to which principles had been applied, how the recommendations had been incorporated. So now, under our apply and explain regime, what we typically do is we have a checklist of the principle, and then we have to show how we've applied that principle, and generally we will show how we've used those recommended practices in King to apply and support the application of that principle. Go and have a look at listed companies have these checklists in their governance sections on their websites. Netcare in particular has a very nice one where they cross-reference the recommendation. They show how they've applied the recommendation, and in what governance document you can go and see how that recommendation was applied. So they've done a very good job of integrating that information for us. And that's what the JSE expects in terms of disclosure from listed companies around their King 4 application. Evidence of application is really the use of those recommended practices that sit underneath the principles as suggested ways in which you can discharge your principle. As you can imagine, the JSE probably is definitely very focused on disclosure to shareholders. As we've discussed in the past, if there is a responsibility that is passed down to a board, then there is a responsibility that goes back to the shareholders around disclosure and reporting how that duty was discharged and those obligations were fulfilled. So the JSE has a big emphasis on disclosure from listed companies which go on to SENS. There are obviously documents which are very long, such as the full annual financial statements or the full integrated report. You wouldn't want to print that entire document on SENS, so you put a link, you can just put a little link to your website on there, but essentially all of these documents need to go out into the public domain, and there are some disclosures that are very specific and have to be made by listed companies at certain points, aside from just the annual financial statements and the integrated report. So, as we have discussed, any trading in shares by the company, by the directors of the company, the directors of the major subsidiaries of the company, any associates of those directors or those directors of major subsidiaries. So, associates are the spouse, the children, the trusts, any other companies that those directors might control. So, if you have a director of a subsidiary company in a holding company structure, and that director's wife decides to trade, then that is constituted as a director's dealing and would have to be announced. It would also have to be subject to certain rules. The company secretary, if the company secretary trades, that also needs to be disclosed on SENS. Then with regards to updates in the market as to how the company is performing, there is a disclosure called a trading statement that needs to be put out. And what this says is it updates the market where the company thinks that its financial results will differ by 20% or more from the previous reporting period. So as it's preparing its financial statements for the year end or for the interim period, and the company is aware of the fact that these results are going to differ by 20%, either up or down. So either the company has done very well in compared to the prior year, or it's done quite badly compared to the prior year. That's very price sensitive information. So the JSE requires companies to put out a trading statement to say that they have reasonable certainty that these results are going to be quite different from what they were last year. And that gives the market some preparation as to what those results are going to be like. And it also makes sure that there's no price sensitive information in the market where one shareholder could benefit at the risk of other shareholders. I mentioned cautionary announcements earlier. This is an announcement that the company puts out into the market where it tells its shareholders that it is aware of something happening in the company that may impact the share price. It's a confidential matter, so they cannot tell you what it's about, but they need to warn you that the share price may be affected and that you should exercise caution when you trade in the shares of the company. So that's a cautionary announcement, and you can see that there is an element of price sensitivity involved in that because the company is doing something. So it automatically stands to reason that those directors and directors of major subsidiaries are probably going to be in possession of price sensitive information during this period and therefore would not be able to trade in the company's shares. So the JSE automatically, through its rules, the minute a company puts out a cautionary announcement, it goes into this closed period. And when the cautionary is then withdrawn, if the deal falls through, whatever the circumstances are, this that price sensitivity doesn't exist anymore, then the directors can trade again. Obviously, the publication of the company's annual financial statements need to be disclosed, and the publication of the interim results, or which is the half year every 6 months. And those are usually a bit shorter, and you can put them on SENS, but nowadays we put them on a link to the website and we make them look very pretty. Go onto websites of listed companies and have a look for these documents. You can find them frequently referenced on SENS. The notice of annual general meeting, that's fundamentally important to shareholders because that's their one opportunity to engage with the board, to have the right to ask questions, to attend the meeting, and to vote on their shares, which is the only real control that a shareholder still has over the company. Then any announcements, any appointments or resignations of directors or company secretary, those must be announced as well on SENS. as soon as practically possible. Typically happens within 24 hours of that resignation or appointment being made. And it's also very price sensitive because these are the people who have a significant control over the company. So that information is important for shareholders to know as soon as possible. If you think back to this agency theory around the shareholders having delegated this authority to the board to manage the company, it's important for those shareholders to know if there are any changes to that management team. It's really quite fundamental. Then the board committees that the board has set up, your audit committee, risk, remuneration, those committees, any changes as to how those committees are constituted, the membership, that must also be announced on SENS. So if you change an audit committee member, you've got to tell your shareholders that you've done that. Sometimes it seems a little bit frustrating to put out all these announcements, but you can understand why it's important, because this is the only communication shareholders really have directly with the company. Okay, and then if there's any other matter that is in the interests of shareholders, anything which ensures that all shareholders are in possession of equal information, very important to disclose. And a few years ago, Alexander Forbes had a leak from someone in its senior management team who had left the company, and they became aware of the fact that this person was disseminating confidential company information in the market. So what they did was they had to put a SENS announcement out where they had to disclose quite a bit of that confidential information and explain the circumstances as to how it had been leaked into the market, so that all shareholders were in the same position. And that was the right thing for them to do, although it was probably very stressful for them at the time. Okay, let's move away from the JSE listings requirements and on to competition law, which is set out in the Competition Act, and an area of law where companies and directors tend to neglect looking, but has been the source of the biggest fines in our commercial sector. I think the fines for anti-competitive practices by companies and fines that have been levied by the Competition Commission far outweigh any fines that have been levied by the JSE. This is also an area where one company secretary was so unfairly prejudiced by his board, who were found guilty and fined under the Competition Commission, and the board turned round to the company secretary and said to him, well, you didn't tell us that the Competition Act applied to us, which I think was a rather silly notion on the part of the directors, because it is a very relevant act in any commercial space. So as company secretaries, please don't follow in the sad footing of that company secretary. Please make sure that your directors understand that the Competition Act does apply to them, and that there is sufficient awareness and understanding of what it says, and that awareness filters down to operational activities. I beg your pardon. The whole point of the Competition Act is to protect the ability of companies to trade fairly amongst each other, and it prevents dominance in the marketplace from larger companies, so that smaller companies are still able to conduct business and to compete on an equal footing. It prevents monopolies from happening, where one sector of the business of the industry is just dominated by one large company. Imagine, for example, you could only shop at Woolworths. There was no Pick and Pay or Checkers, and you had no choice but to buy at Woolworths and to pay those astronomical prices that they charge for a lot of their goods. The other purpose of it is that it prevents any conduct that lessens competition. So it allows more entrants into the market. The idea being that we want to promote healthy competition between service providers. When you go to the banks and you want to engage with a bank, you do go and have a look and see what they each charge you. And you wouldn't want them to be phoning each other up and saying, right, let's let's all agree to charge 10 Rand per transaction, and then you're stuck with that. They've decided for you. You do want that competition as a consumer, so that you can potentially pay less in your market fees. They can compete for your business. There are healthy aspects to this. So it particularly prohibits any conduct where two horizontal companies merge. Horizontal companies means two competitors that are on an equal footing where they were to merge. So can you imagine if we had Pick n Pay and Checkers combining together? We would now be stuck with that merged entity and only Woolworths. So those mergers of two very big companies that do substantially the same thing can result in market dominance, and we don't want to have too much market dominance. So that's prohibited. Um, the merging of any vertical companies. So those are companies where there's in a value chain a customer and a supplier relationship where they now combine together, and then you can no longer be a customer of that particular company, or you can no longer use the supply from that particular company. So that also results in a lessening of competition. So to use our illustration, all cabbage farmers now can only sell to Checkers, and if you want a cabbage, you've got no choice, you've got to go to Checkers. That lessens competition in the market. The other thing that is not permitted is fixing a price. So you've often, I'm sure, heard of these sort of price fixing, but you've probably seen on lots of products recommended price. We used to see it a lot on Coke tins, and there was the idea being that the manufacturer can only say what is the recommended price, but if they say that you must sell it at a certain price, then that lessens that competition in the market, that ability to be competitive, and goes to my banking example around my 10 Rand. Any type of collusive conduct between competitor companies to secure a contract or to divide up the market or fix a price, that is prohibited. And this is what happened in the construction sector, particularly with regards to the building of the World Cup stadiums. So what happened was there were 4 or 5 large construction companies, and they divided up the market between themselves. They agreed that one company would get Soccer City, one company would get Cape Town Stadium, one company would get Bombela, and between them they made sure that their tenders that they submitted promoted that. So if, for example, Avenge was going to get Soccer City, then there was an agreement that they would submit the best price. So they shared their price information with their competitors, and they got the best price, so therefore they were awarded that particular stadium. Now, just a disclaimer, what I'm telling you is not necessarily confidential, but I am oversimplifying it for the purposes of our discussion today, and there are a lot more factors that went into it, but I'm trying to illustrate what collusive conduct is, and a good market example of how it's taken place. If you want to know more about that, there's lots of information freely available for you to go and research. And then any action which prohibits a competitor from gaining access to a scarce commodity. This typically happens in the chemical environment. So where there's a manufacturing company that requires a scarce commodity, if we think of a facial products, any very scarce oil that might go into a facial product, all of those competitors in that market that make face creams and facial products, they will be trying to get that scarce commodity. And if one of them were to secure the only source of that product, then that commodity, then none of the other companies would have access to it, and they would go out of business. So any conduct in that regard is also prohibited. Just looking at our first 2 little squares there, where we have merging of companies, any merger and acquisition over the value of 80 million rand, where the acquiring company has a revenue of over 80 million rand, those need to be approved beforehand by the Competition Commission. So you do have deals where there are competitors who combine, or customers and suppliers that combine, but it has to be done through very strict controls, which the Competition Commission will oversee. If you are guilty of any of those 5 little squares, you are subject to large fines. It's probably only the last 3 squares that will result in a fine, because the first 2 squares you've got to go and get approval for the Competition Commission. They're just not going to approve something if it conflicts with the Competition Act. Whereas any of these price fixing and collusive conduct and trying to keep your competitors out of your scarce commodity markets, that nefarious conduct that might happen in business practice, that's typically where we find very large fines that are happening. And it can attract personal liability for directors. So if they do this, a company will do this. Those directors will be held personally responsible for the damages that the company suffered. So the company will have to pay the fine, but then the company can look to those directors for those fines to be paid out of the directors' pockets, to be refunded to the company. Remember that the company owns assets, and it owns assets that the shareholders have invested in. So if the directors commit a crime, or breach the Competition Act in the course and scope of looking after these assets for the shareholders, it's not fair that the shareholders then lose their assets in the company by having to pay these enormous fines out. Particularly interesting example in that regard was with Steinhoff. It's not a competitive issue, but on the subject of fines, Steinhoff was fined billions for its contravention of its financial reporting, but the JSE felt that the shareholders had already suffered so much from the loss in the share price that they reduced that fine substantially down to, I think, if I recall correctly, about 50 million rand. So that was a very, very big fine that the company had to pay. It was reduced substantially, and then Steinhoff will now be able to sue its directors who caused that or allowed that poor financial reporting to happen. So just to harp a little bit on how that personal liability chain unfolds, and it would happen in exactly the same way with regard to competition law. Right, back to our Companies Act and the infamous solvency and liquidity test. Now, this is set out in Section 4 of the Companies Act, but it cross-references quite a few other sections of the Companies Act. So what happens is this section sets out the solvency and liquidity test, but there are a lot of things in the Companies Act which require the solvency and liquidity test to be applied, and we will talk about that quite a bit in this section. So if you go back in your mind to my example around how the shareholders have invested into the company, and the assets of the company are owned by the company, and that constitutes that shareholders' investment, the value of the shareholders' investment. You want to try and protect that asset that's in there from being distributed out in any way that it shouldn't be. So what this rule says is that in any instance where the company makes a payment or a distribution that is not in the ordinary course of business, then the board must apply the solvency and liquidity test before it makes that distribution or that payment. So this is not for paying salaries and not around paying your suppliers, any of your day-to-day operational payments. This does not apply to that. This applies to unusual payments, such as a loan to a director, a loan to another company in the group of companies, a loan externally to an unrelated company from a company that's not a lending or a micro lending business. Obviously, if it's a micro lending business, such as a direct access or RCS, those payments, those loans would be made in the ordinary course of its business. That's what it does. But those are very unique companies. So our typical companies, any company, any company that is, this doesn't only apply to listed companies, this applies to all companies under the Companies Act. Any distributions to shareholders, instances where they want to buy back shares, this solvency and liquidity test must be applied. The purpose being to protect these assets of the company. So let's look at solvency. What do we mean when we say solvency? This relates to the assets of the company. Fairly valued must be equal to or exceed the liabilities of the company before this distribution is made. So we must assess before the distribution is made that the assets fairly valued will always exceed the liabilities of the company once we have made this payment. So we're going to lend R1 million to someone, and before we lend them the R1 million, we check that our company's assets exceed our liabilities after we've paid the R1 million. Will it still exceed its assets and liabilities? If yes, then we've ticked the solvency box. That information around assets and liabilities you'll be able to find in the balance sheet, which is now referred to as the statement of financial position. Liquidity relates to the company being able to pay its debts as they become due and payable in the ordinary course of business for the following 12 months after this loan or distribution has been made. So this is, once we've paid this R1 million out to this person, firstly our assets must still exceed our liabilities or be equal to our liabilities. And after we've made this payment for the next 12 months, we must still be able to pay our debts as they become due. We must still be a healthy business once we've let this money go out of our coffers. And that information on liquidity you would find in the cash flow statement and in the income statement, which we also now refer to as the statement of profit and loss. And any directors or a board that makes a decision to distribute money outside of the ordinary course of business and does not pass this test, or they disregard the test, that is an automatic breach of their fiduciary duties and is also an automatic breach of Section 77, and they would automatically incur personal liability for the damages that the company suffered as a result of that loan being made when it couldn't afford to do so. Let's have a look at transactions that require the solvency and liquidity test. This is where the Companies Act specifically says if you are going to do this thing, you must apply the solvency and liquidity test as set out in Section 4. So, Section 44, that deals with where a company offers financial assistance to someone, typically a director or related party, to buy shares in the company. And this would happen where we had a share incentive scheme. That's considered lending money to someone to buy your shares, even if money doesn't actually physically pass hands. It's still considered financial assistance, but this is financial assistance specifically for the purpose of buying the company's shares. Section 45 is where we are going to lend money or offer any financial assistance to any related parties, any subsidiary company, any holding company, any directors and their related parties. So anyone connected to the company that we might lend money to or provide financial assistance to. I will go through a little bit more detail what financial assistance constitutes and some examples of it. But where we find this happening most often in day-to-day business is where in a holding company structure, and you've got lots of subsidiary companies, and for treasury purposes, the accountants love to move money from one company to another company for various legitimate business purposes. unfortunately, when you take that money from the one subsidiary and you put it in another subsidiary, that constitutes financial assistance and it becomes a loan, and you have to then do these financial assistance, meet these financial assistance requirements, and including passing the solvency and liquidity test. It can be quite tricky, and it drives accountants mad because every time they do this, they then have to go through all of these processes. The most obvious one that one can understand is Section 46, the dividends to shareholders. So where the company is going to pay out a dividend to its shareholders, it needs to make sure that there's going to be sufficient money left in this company that it will still be solvent and it will still be liquid. It can't pay out all its money to shareholders. And this presents a nice buffer between the board and the shareholders. So the shareholders can demand, they can have a whole temper tantrum if they want to about getting their dividends. But unless the board passes that solvency and liquidity test and are satisfied that the company meets those requirements, then those shareholders have no right at all to that dividend. The directors do not have to declare that dividend if the company does not pass the solvency and liquidity test. There are other sorts of distributions also included in Section 46, such as writing off debt that is owed to the company by a shareholder. That also constitutes financial assistance and would also have to go through the solvency and liquidity test. Capitalization shares, which is where a shareholder can either take shares or take cash, and we often refer to this as a scrip dividend. So instead of paying a dividend in cash to shareholders, we now give them more shares in the company. So that in the same way is a distribution and has to pass the solvency and liquidity test. Where the company wants to buy back its shares, that is also considered a distribution because money is going out of the company which is not in the ordinary course of business, so also has to pass the solvency and liquidity test. And then less frequently, where you merge two companies together, you need to pass this test. Let's look at examples of financial assistance and what constitutes financial assistance. Long-term loans, that sounds pretty logical. Intercompany loans, cash management or clearing accounts that are set up for a group, as I explained, through a treasury function that happens quite often in companies. And any transaction with a related party that might have an unreasonable or unfair term, such as an excessive interest rate, anything that might not be beneficial to the company. Subordination agreements where two companies owe each other money and the one company agrees to subordinate its claim against the other so that that company doesn't have to pay its creditor unless particular solvency issues are met. That is a financial arrangement. It constitutes financial assistance. Providing guarantees and surety for another person's debt or another company's debt. So if you have the subsidiary company structure and one stands surety for the other, and that includes pledging of assets as security for somebody else's debt. So if you've got tractors in one company and in another company in your structure wants to enter into a contract and you pledge your tractors from company A for the liabilities or the obligations of company B, that would be financial assistance. Where you decide to settle a liability on behalf of another company, even if you recover this at a later date, so company A pays company B's debt, even if company B is going to repay company A, that still constitutes financial assistance. And then any loans to directors and prescribed officers and related parties. So I can't begin to imagine that my boss would take a loan from the company, but it does happen particularly at smaller entities where directors might have less of an oversight of what their responsibilities are. Okay, an exchange of assets where payment does not take place simultaneously. So if Company A has its tractors and Company B would like those tractors, it has cash. So it buys Company A's tractors, but it doesn't pay for them immediately. It pays for them in 6 months' time. That constitutes a debt and financial assistance. And then this very last bullet point is my favorite one. Company credit cards, typically that directors hold, where a director uses it for personal expenses, even if they subsequently repay them, that constitutes a loan to a director, to that particular director. So I do have a chuckle if the director uses his company credit card to pay for his family's dinner, even though he thinks he'll just pay it back at the end of the month. That very act of swiping the credit card did constitute then financial assistance, and he should actually have rung up the board and asked them to do a solvency and liquidity test at that time, which I can just imagine you picture would be quite amusing. I do think it's worth letting your directors know that this last bullet point does exist, because you want to try and keep them out of any instances of having this personal liability. Let's have a look then at the whole structure of how financial assistance takes place. It has to firstly be permitted by the company's MOI. So the company must allow the MOI, I beg your pardon, must allow the company to extend financial assistance. Most companies' MOIs do permit it because it is a functional activity frequently found in business. As you will have seen, it's not purely related to lending money to your directors. There is an operational need for it to take place from time to time. So the MOI has to say yes first. And then you have to go to shareholders and you have to get a general authority from them to allow the company to provide financial assistance. And typically what we do is every 2 years we go to shareholders and we ask them for a general authority that if the need arises, that this company may provide financial assistance. And if in that instance it does need to provide financial assistance, the board will apply the solvency and liquidity test. Where you can find these resolutions is if you go to the notice of AGM of any listed company, have a look through that notice of AGM, and you will see that section 45 general authority in that notice. Have a look at the wording. It's quite interesting to see it in practice. Okay, and of course that the board, prior to providing the financial assistance, applies that solvency and liquidity test. So here's a little diagram. So if you're going to be providing financial assistance to any directors, officers of the company or related companies, and it is not in the ordinary course of business, and it is allowed by the MOI, and the shareholders have approved by special resolution these last 2 years, and you've applied the solvency and liquidity test, and it has been, the company will continue to be solvent and liquid for the next for the next 12 months after the test has been applied, and the terms of the financial assistance are considered to be fair and reasonable to the company. And if the MOI has any other requirements that it might have, if all of those little boxes are checked, then you have a valid transaction. So be very careful when your shareholder, who's also a director, wants to borrow money from the company or has a company credit card. Make sure they understand this section very well. Okay, Let's move on to corporate governance around the world. This is quite interesting. We don't live in I think COVID has made us very aware of the fact that we don't live in isolation in our little country, that we live in a very close global community. So corporate governance around the world is particularly important. It has an impact on all of our companies that have international and multinational footprints, and it has an impact on how we operate our own governance structures. There are different types of governance systems across the globe, and I will give you some examples of these. One of these differences that happens is in how the boards are structured. So in South Africa and in predominantly Western companies, we have what is called a unitary board structure, or a single tier system, where you have one board, a single board of directors, which is then made up of executive directors and non-executive directors. In the Far East and Germany in particular, they have what is called the two-tier system, or the supervisory board structure. And what happens here is you have two boards. The supervisory board, which is appointed purely by shareholders, and there are no executives. Everybody on here is independent. And that board then supervises the appointment of a management board underneath it. And the management board then is responsible for the day-to-day functions of the company. And here is a little illustration of what that looks like. Just going off to the left there is the unitary board structure, where we have the single board with your non-executive and executive directors. That's what we use in South Africa. And then in the dual two-tier structure, you have two boards. You have a management board and a supervisory board, and the supervisory board has control over the management board. The supervisory board is I don't know that the structure necessarily provides you with any better certainty. VW, a German company, had this structure in place when VW fudged its carbon emissions on its cars and had to pay enormous amounts of fines. I don't know that one structure is necessarily any better than the other. Then on a global scale, we have the OECD, which is the Organization for Economic um, Development, and it is an international body that assists companies, developing countries, I beg your pardon. It applies to countries, not to companies, and it helps countries to um, improve their internal arrangements and their internal governance, in order that they will, with the intention of them becoming stronger. And it's very much supported by the World Bank. So where the World Bank lends money to developing countries, they would be interested in making sure that these OECD principles of corporate governance are applied in that country. South Africa is a member of the OECD, and so we also have these principles. The idea being, and amongst the guidance that is provided is advice and assistance on economic matters that may help a developing company adapt to the demands of an international economy. Assisting governments with their efforts to improve legal, institutional, and regulatory frameworks for corporate governance in their own countries, ensuring international financial stability, and improving corporate governance in in emerging markets. It also provides a lot of input into stock exchange rules, various institutions, directly into companies and other organizations. It plays a role in formulating corporate governance practices, and certainly when the King Committee developed any of the four King iterations, they would have had a look at the OECD principles. They first were published in 1999 and then again in 2002. and they provide a benchmark for the countries that subscribe to the OECD. And the Financial Stability Forum, which is an international body which measures global financial stability, requires this as a standard for countries as a whole in how they assess their financial stability. Let's have a look particularly at some of these. In 2004, there was an update where governments of 30 countries in the OECD sector came together to approve a revised version of specifically the corporate governance recommendations. The practices and their recommendations revolved around good corporate behavior, rebuilding and maintaining public trust in companies and stock markets, calling on governments to ensure effective regulatory controls, and for the companies in those countries to be well governed and accountable. It also tried to increase awareness among institutional investors and that effective role of shareholders in how directors are paid and remunerated. So very similar to our in King 4, our Principle 17 that is specifically directed at institutional investors. These principles also intended to strengthen transparency and disclosure and to counter that downside of conflicts of interest that might happen. There is also the International Corporate Governance Network, and this was started in 2003. And this is a group of institutional investors, international institutional investors. I beg your pardon for being tongue-tied. Okay, so this is all our institutional investors that we typically think of in our companies. So Liberty, Sanlam, PIC, Alexander Forbes, and so on. This is an organization for them, for the institutional investors. And it's a global institution, it's a global network, and they provide advice on how institutional investors should behave. And these 4 little arrows on the slide, very similar to what we find in our King 4 Principle 17 for institutional investors, and similarly in the CRISA code. So institutional investors have a general responsibility to ensure that investments are managed exclusively in the financial interest of their beneficiaries. So when we are investing our pension fund money, it comes out of our salary and it goes into one of these institutional investors like Alexander Forbes, we want to make sure that they invest our money with our financial interests at heart. Institutional shareholders or investors should contribute to improving and upholding the corporate governance of the companies and markets in which they invest. So because they are such significant shareholders, they have an opportunity to sway the board to vote against resolutions that don't uphold good corporate governance, where an executive director has a salary that is just astronomical and the company's not performed well. The institutional investors have that voting power to vote against it through those non-binding advisory votes. So there's a lot of power that these shareholders have, and we want them to use it to promote good corporate governance. So where internally in institutional investors, investment entities, they must have a focus on preserving the the preservation and growth of long-term value in the companies in which they invest. So aligned to the second bullet point there, upholding the corporate governance, this involvement must also preserve this long-term value of the company, ultimately to achieve the sustainability. And they must show concern about corporate governance as a key issue. And this particular statement, it is clear that institutions risk failing to meet their responsibilities as fiduciaries if they disregard serious corporate governance concerns that might affect the long-term value of their investment. Where this is important and where we're seeing this quite frequently is institutional investors that will not invest in a company that does not have a climate change policy. And that's quite significant, and I think is pushing companies now to think more seriously about climate change. Let's have a look at corporate governance in the United States. Like many things in life, the United States tends to do things slightly differently. And this is why their corporate governance structures and systems are very different. In 2001, the largest energy company in the world, Enron, um, it completely um, went down the drain. There's no other way of saying it. It was the biggest corporate demise. Even Steinhoff has not managed to beat it. Even when you translate the time value of money, Enron was still bigger than Steinhoff, and we hope we never see an Enron again. So it was this Houston-based commodities company, and shareholders ended up losing 74 billion rand. Thousands of employees lost their jobs, their retirement funds. The key players in all of this were two CEOs, the current one and the former one. And what they were doing, funnily enough, not too different from what happened at Steinhoff. And part of what happened at Steinhoff was they were keeping the debts off the balance sheet. So they would ring fence all their debt in companies that were not consolidated back into the company's financials. So I would love to do this in my personal capacity. If you looked in my financials, you wouldn't see my bond anywhere. You would see the asset of my house, but you wouldn't see my bond payment. I think that would be fantastic. My credit score would go up dramatically, but that's not how it's supposed to be done. And that's how, on a company scale, they were doing it. They were taking the debts and putting them externally from the company, so that when you looked at the financials, you only saw the asset and the performance. You didn't see this massive debt that offset it. And they were, how this came to and how they were caught was through a whistleblower, and suspiciously high share prices that just kept growing and growing and growing. So a very important governance process is whistleblower protection, because it was due to a whistleblower that this particular scandal was uncovered. Okay, and then Fortune magazine had named Enron previously America's most innovative company prior to the scandal. So they did a very good job of covering this up right up until the entire company crashed. The result of that was that the government introduced what's called the Sarbanes-Oxley Act. We call it the SOX Act for short, SOX. And this made certain corporate governance actions mandatory. They're not voluntary basis for governance like we have in South Africa, not like King with its recommendations and principles. This is a law, and companies have to apply it. It applies to all companies in the US, and then companies that are listed on the New York Stock Exchange obviously have additional regulations that they have to meet. They focus mainly on the adequacy of internal controls. So that focus around where those debts are sitting and who's doing what and who's signing off what, and who has authority within the internal structures are a big focus of these rules. And right at the top, the CEO and the CFO have to make certifications that all companies that those companies have actually complied with these rules. SEC stands for the Security Exchange Commission, which is like our FSB, our FSCA now. They have to give personal confirmation, vouching for the accuracy of the company's financial statements. If there is any material non-compliance with any of these accounting rules that they have, then SOX makes the CEO and CFO forfeit any of their bonuses. So I think that one has probably been quite a deterrent to doing nefarious things. Let's have a look at the New York Stock Exchange rules and recommendations. These apply to, so as much as it says recommendations, they're actually rules. These are like our JSE listings requirements. They apply to all companies that are listed on the New York Stock Exchange. It also says the majority of directors should be independent, and the role and authority of these independent directors should be increased. There, with the definition of independent in their ambit is much narrower and stricter than the 10 criteria that King give us. The non-executive directors should meet regularly together without any management present. The audit, nomination, remuneration committees are required, and they must have only independent non-executive directors. The audit committee has increased responsibilities, and there are minimum requirements for qualifications for members to be on that audit committee. Non-executive directors on the audit committee must remain independent, and their only remuneration from the company should be their remuneration as a non-executive director. So that's very similar to South Africa, where our non-executive directors cannot receive remuneration from the company that's not that isn't fixed or and approved by the shareholders. Nothing that's performance based, that sort of thing. They can just receive their fee, and that is it. Shareholders should be given more opportunities to monitor and participate in the governance of their company through stakeholder engagements, those sort of things. There are mandatory publications for the New York Stock Exchange listed companies of their governance, corporate governance guidelines, so very much like our corporate governance reports. And there is a code of conduct and business and ethics, which we have too, which is not mandatory for us, but a recommendation. Okay, and then they also have a recommendation that education and training of company directors should be improved on an ongoing basis. And that brings us to the end of our slideshow and our lesson. Thank you very much for listening, and I will put up some more notes during the course of the week and some more videos. I don't think that we're going to miss a beat at all.